Hello, this video is for beginner. If you're a pro, you don't have to consume this video because I solely created this video for beginner trader, those who keep losing in the forex market, those who do not have the secret to trading successfully in forex. So one of the key things you need to know as a beginner is market structure. Once you can read the structure properly, knowing the directional bias, then you are 50% to the promised land. And in this video, I'm going to dissect everything you need to know about market structure. I'm going to show you in a simple form, a textbook format, and how the market operates in the real life. All right. And this can also be used both in the higher time frame and in the lower time frame. Now, this is what I mean. This first phase here, where you see market move like this, I know a lot of people have taught you that market, when it creates a lower low, in this case, this is a bearish market. The bearish market is a market where the market keeps creating series of lower high and lower low. When you see such, then you have what? A market structure to be what? Bearish. Now this is a textbook format. All right. And now what did they teach here? In this case, what it says is that whenever you see a break of structure, when price comes back to area of premium, for example, you trade off the other block and you continue selling. Price coming here, you trade up to the other block and you continue selling until price change market structure. That's what you have been taught. And there's nothing wrong in doing all of those things, okay? But what I want to show you is a bit different, because for the problem is lying down in this place, okay? When market takes out this high here, for example, this is not a shift in market structure. I know you've been taught that whenever you have a break now, this is a change of market structure chalk, and it signifies that when price comes back down to this point, you start looking for trades to the upside. But that is not how the market works, okay? I've been in the market for so long, I've been trading for so long that I understand different patterns that the market creates each and every single day. So now, what you need to know is what I call the original structure range, okay? OSR, original structure range. This is simply the leg that must be taken, because sometimes you can see a low, a high, another low. This could simply be one big move, okay? This could be an impulse leg. All right. So if price, for example, let's go back to where this is, this example here, low, high, low. This could be one big leg, okay? And then this is a pullback, even if it closes above this. All right. Even if price closes above this, that doesn't make it change. It is when price take out this high that I will now be looking for what? Bullish price action. All right. So take note of the OSR. Those are the key things you need to know. The OSR. Now the OSR is simply when you see the low that was taken, trace back the high. That low and the high is simply your what? OSR, and that is your trading range where you'll be taking trades. The best point of interest is those point of interest within the OSR after this high has been taken. All right. That is market structure in a nutshell. Now, this particular pattern here plays out, this textbook format plays out more in the higher time frame. Okay. When you go to the higher time frame, it is cleaner. Market structure is cleaner in the higher time frame, like the monthly and the weekly. Okay. On the weekly time frame, when you have something like this, when price comes to this point, you can sell, because this level here, the candle that was formed within this period here, are simply big size candle, meaning a lot of volume came in to push price down. A lot of orders came in to push price down. Now those orders are not just thousands or millions of what orders, they are billions. So you should expect a form of reaction when price comes there. So you selling at this point is not totally wrong. But however, you should know at the back of your mind that even when this goes, that doesn't change the market structure. Okay, sometimes price may just go up and take out the high that was created, and that is called liquidity sweep. Once that high is created, it may continue going in the bearish direction. All right, so a simple and clear illustration like this works best in what? The higher time frame. Now when you are trading in the lower time frame, that is where there's a lot of noise, there's a lot of manipulation within the lower time frame. And by lower time frame, I simply means from 4 hour H4 down to the 1 minute. Okay, within this time frame, one has to be very careful when you are reading market structure, and that is why in the lower time frame, always wait for this to be taken. All right, so that means when you see a structure like this, low created, high created, low created, this could be one single leg. All right, this is what? One single leg in that particular time frame, or in a time frame higher than that. So a close above this does not mean that the market structure has changed. What it's simply saying is that this high here within that lower time frame now is called the inducement. All right, there are two things that move the market: the price and then liquidity. Without liquidity, price will not move. Liquidity is more like fuel that the market needs to push. So now, if you look at this particular level here, why is this an inducement? This is an inducement because a lot of stop orders are seated up here. People are putting their stop loss in here. And who are these people? Those are people who are taking trades in this place here. This the supply zone, this order block, fair value gap, whatever it is. They are all taking trades within here. And where are they putting their stop loss? Up here. So as a beginner, if you try to trade like this, you get burnt every single time. So that means what you need to do is identify your OSR. In this case, this is the high and the low. Once you know your OSR, a close above this or a sweep above this do not mean a thing. As long as it doesn't take the OSR, you keep selling. So you look for a point of interest simply above this, and then you sell from there. Price will move. Now when price move, this becomes the new high, lower high. All right, not this. This is not the lower high. This is not a lower high. When you are going to the lower time frame, structure isn't that clean anymore. All right, so in that case, you have to use this approach I'm showing you. Once the liquidity is taken, that high produced is what? Is the lower high. And why is it the lower high? Not just the lower high, it's a strong high. Okay, a strong high is simply a high that takes liquidity and then breaks structure. All right, so within the lower time frame, always look for what? Your strong high, and that becomes your lower high. I will explain this on the chart. All right, always look for your strong high and strong lows. Those becomes what? Your structure high. Now in this case, price came back down, push up. Most people will label them as a lower high. There's no doubt, but since I see this break here, it creates an OSR, original structure range. So within this original structure range, that is where I want to be selling off from. Then I want price to take out this. Once price takes out this high, this is a strong high then. Okay, and when that high breaks a low, it becomes what? A new lower high. And that low that it broke becomes your what? Lower low. So we have a lower low here, we have a lower low here. All right, So do not be confused when it comes to market. All you need to do is look for your strong eye. That your strong eye simply is the eye that needs to be taken, and that is the OSR range. All right. Now for the bullish case, let's go and check the bullish scenario. Now for the bullish scenario, as I said, there's nothing wrong with this pattern. Yeah. There's nothing wrong with this. If you are doing this, this is a low, higher low, higher low, this is higher low, this is a high, this is higher high, this is higher high, okay, and this is higher high. Now pay attention. Doing this is not wrong if you are on the higher time frame. Okay, if you are on the higher time frame, like especially on the weekly. Okay, most times if price comes back here, it does not, most times it may not take the weekly lows. Price will simply respect whatever other block is in here or any point of interest here and then continue pushing. On rare occasion, it will sweep the liquidity and then keep moving. Okay, so when you see people teaching you that this is not market structure, they are wrong. This is market structure. It all depends on what time frame are you applying this. And I can tell you that this can only be applied in the higher time frame, because higher time frames are cleaner. I'll go to the chart and I will show you both this and what you see in the lower time frame. In the lower time frame, there are a lot of noise. Okay, now this particular one is for the lower time frame, like the 15 minutes. Okay, we have a high, a low here, price push, created this, push again. Now creating a structure, break of structure. This break of structure, if it's in the lower time frame, it creates what is called the OSR, original structure range. That means you have to wait for this liquidity to be taken, because less informed traders will be looking for trades within here to buy. But you simply look for trade below this low. So when price come in here and push, this is your break of structure. So this is your next what? Higher lows. In this case, this is a strong low. A strong low is a low that takes liquidity and breaks structure. A BOS. So as I said, this becomes the low. A strong low is a low that takes liquidity and break structure. Okay, take note of that. It takes liquidity, break structure. So all you need to do is look for your strong lows within the lower time frame. The lower time frame could be H4 down to what? The 1 minute. Sometimes it can apply on the daily as well. Okay, but the weekly and monthly are more cleaner. This kind of market structure surface. Okay, so when this push high, it creates this is the main break of structure now. Okay, and then a push back, a break of this creates the what? OSR. So this is your range. Do not trade any point of interest before this high. Okay, when you do that, it is a low probability. All right, this point of interest will not hold water. So always wait for this liquidity to be taken. This is an inducement. Traps that smart money put in place, okay, to take your money. But what do you need to do? Look for the closest point of interest here. Once this liquidity is taken, then you continue pushing ahead. All right, and so on and so forth. Now I will go to the chart and show you both in a very clean scenario and then in the lower time frame scenario. Now a good example is this. You can see the structure leg from this down to this point. You can see how clean it is. We have market move, take this low, push up again, took this low, push up again, took this low. Now as you can see, there's no form of liquidity inducement there. Okay, there's no liquidity inducement because this is a higher time frame and then the money flows with ease. They pump in a huge amount of money. All right, the smart money trades on the higher time frame. Okay, because they know that the retail traders spend most of their time in the lower time frame. Okay, and that is why most of the time I use the higher time frame to determine my directional bias. Because if the weekly is going down, there's nothing like, oh, let's wait for inducement to be taken. The money seated there are so huge. Just one candle in the weekly time frame is very big. Okay, so if you can see, just from here to this point, did you see any form of inducement? And this is how many weeks? 1, 2, 3, 4, 5, over 20 something weeks, almost a year of money flowing in the same direction. But when you go to the lower time frame, you are going to see manipulations, and that is where they manipulate retail traders out of their trade, even though they know that the market is bearish. Also going up, okay, market took this, went up, took this. There's no liquidity sweep aside from when it wants to retrace. It created a break, and then from there market continues again. Break, a push high, break. You can be selling in here until it breaks. All right, in this case now we are bullish again. This low now, from what you have been taught, okay, some might say this is an inducement. No, it is on the higher time frame. On the higher time frame, don't look at the concept of inducement on the higher time frame. When you do that, it doesn't work. All right, so if you have not taken anything out of what I'm saying, on the higher time frame, do not focus on inducement, because the price action is so clean that market respects whatever point of interest you have on this weekly. Okay, now because you've seen a particular illustration that, oh, there's inducement everywhere, you start looking at every market structure on all time frame. That is what people teach wrong. Market structure reading on all time frames are not the same. The way you read structure in the higher time frame is different from the way you read structure in the lower time frame. The higher time frame structures are easier to read, and what you use them for is simply for direction. Use them for direction. Okay, don't use them for any other thing aside from direction. Then you go to your lower time frame, which we are going to go into now, and start trading using what the concept of inducement. Okay, so if we go through this gold again in the lower time frame, let's say 15 minutes. Let me use another broker. Okay, and now let's just observe that same movement. In this case, we have a reversal here. Price move, push up, move down. Now this is where you apply the concept of inducement. Because you see a break here doesn't mean you should sell from any of these points of interest. Doing that is suicidal. Okay, what you need to do is to locate a point of interest above this high. This high is what? Inducement. Now, why am I using this way of market structure reading? Because I'm in the lower time frame. Lower time frame in the sense that I'm trying to look for entry. Remember, the higher time frame, which is the weekly, we are not looking for entry. We only use it for what? Direction. And that is why we have less manipulation there, because that is where the big money enters their trade from. Because they have the billions. They can take a trade at a particular price. They have enough capital to hold on to whatever drawdown it is before it moves to the intended direction. But we retail traders may not have such luxury. So we move to the lower time frame where manipulations is the order of the day. So in that case, you have to be strong. Okay? Now, from this illustration here, we have this sweep. Market came in. But failure of this to take out this low simply means that we don't have a strong high yet. Okay? So market manipulates more. We didn't take out this low up until this high yet. Now this is the lower high that was created, because this lower high is the strong high. Takes liquidity and breaks structure. Alright? Now in this case now, when market broke structure here, it created a pullback. Market broke structure, created a pullback, then went again. Now listen attentively. As a result of that, what happens as price comes in here, someone like me, I will not be looking for trades until we have this broken. Now once this is broken, it created another inducement here. Okay, created another inducement. That means you look for trades above here. But in that case, what happened? Market still went low and took out this. Now, having taken out that particular low, you continue. Sometimes you'll be patient. Okay, when market took out that low, in this case, took out this low, it went down, created an what? Inducement. But in this inducement, when market took it, it did not take out this low. All right. So what happened? Market, once you see this happening, it means market wants to go higher. In this case, the market went higher until it came back in here. Now, in this level, yeah, we have our original structure range. Okay, we have our original structure range here. So price tap into this region, creating a what? A strong high. From that strong high, we were able to break this. So this is the high that needs to be taken if market wants to go what? Bullish. This is the high that needs to be taken if you want to go bullish. Okay, now what do you see here? In this case, once market take out this, the market becomes what? Bullish. So reading structure is very, very important. Okay, you can do that. Even go to the lower another pair, whatever pair you are looking at. Let's look at Euro USD. The lower time frame is full of manipulations. All right, so you have to pay attention to your strong lows and what strong highs. So as you can see, this is the low. Market took out this low, push up, came back down, push up, came back down here, push up. Now all this while, I will not advise you to take those trades if liquidity is not taken. All right, so this is the movement. We have this, we have this, we have this. Now when this was created, it created a pullback and then a break. Yeah, so from that break here, this is an inducement. You can now take the trade once this high is taken. All right, you can see how patience is very important here. I'm not going to show you a kind of okay perfect condition. Sometimes you simply sit on your hands. You don't take trades if based on what you are trading it doesn't speak volume of the entry. All right, in this case, if you are using your market structure to take your trade, you don't have any trades, because if you keep selling from all these levels here without inducement being taken, most of the time you will be smoked. All right, so always wait for a form of inducement to be taken. Like in this case, once this is taken, then this is your entry. You can break, and then this becomes your high. This is your lower high. So this is the low. Now once this is created, creating a new level, a new break here, we have a push up here, another break here. In this case, if you try to sell within this level, then you will be smoked. Simply wait for this to be taken, because this is the inducement. Now once price takes that inducement here, it tap into this hidden base and then went break structure, pull back. This pullback are simply inducement. Now because price did not get there doesn't mean your concept is not right. All right, let's simply put a level there. Because price did not get there doesn't mean it's not right. Now you continue, look for the new inducement, a break, push, a break. Now in this case, once the inducement is taken, then you can still trade. All of this here becomes valid. Maybe I'll do another video on this. They become valid for your what? Your entry to start trading to the downside. All right, always wait for the inducement to be taken. Once the inducement is taken, and it doesn't fly from here, from the next point here, just simply wait that price wants to get to the extreme. When it gets to the extreme, it will move. All right, now when it moves, it breaks structure. That's your structure leg here. Okay, the moment it breaks that structure, you then start calculating your new inducement here. So in this case, your new inducement is here. So once this is taken, if not for here, the extreme. All right, and then from the extreme, it got broken, creating another inducement once this is broken. So once this is taken, market simply what? Move to the downside. So you can see how effective it is when you use inducement within the lower time frame, because in the lower time frame you want to be taking trades, while in the higher time frame you are simply gauging your direction. So the textbook version of market structure is not wrong. It's just that you have been using it wrongly. Use that within the higher time frame, okay, and then use that to gauge your direction. Then go within the lower time frame and use the inducement concept to take trades. In the next video, I'm going to do a trade breakdown of one of the recent trades I took using this particular concept. If you have any question, feel free to put it in the comment section. Like this video, subscribe, so I can bring out more content like this to help you become a better forex trader.